Rebecca, great to have you with us. So really, we're not expecting much to come out of the FOMC in terms of a change in the rates this week. But when it comes to perhaps clues of what can happen next year, what will you be watching out for, especially with these resilient jobs numbers?
Yeah, great. And it's thanks for having me. It's a great question. And I agree with a lot of the sentiment that was just expressed in the lead open to this topic, because, we've been experiencing all year, and really the last several years probably, that bad news is actually good news, because when bad economic news has come out, that means the Fed was going to help us by doing something. And so now we're getting a surprise beat to the upside. We expected about 160 to 175,000 jobs, and we got 199,000. Right under 200,000. And so now everyone's thinking, well, the Fed has got, a robust economy and it's achieving potentially a soft landing. So therefore, we don't need to see potentially cuts as fast as the market's pricing them in, as fast as March. I think that the U.S. will cut and pivot next year, but I agree that it will be after Europe. I don't think Europe will cut until April. And so I think that there's no chance that we're going to see a March cut, and that we won't probably pivot until the second half of next year. And that's exactly why this good news is actually bad news for the market, in insisting that the Fed cut rates faster than they probably otherwise would.
Why don't you expect a cut sooner to come from Europe, given, of course, the economic fundamentals being really much weaker than here in the U.S.?
That's exactly why. I think that, the United States experiences the economic repercussions of monetary policy last, because we are the world's, hegemonic global reserve. And so Europe, especially Germany, Germany has been in a manufacturing kind of depression for the last 24 months. And that is absolutely having a dire impact on Europe. We've got the UK with its own situation. So I see that Europe will need to cut faster than the United States. And I don't see they have any opportunity to cut before April. And so I just don't see a March cut. And the market has done this
Why
before.
Doesn't it have an opportunity to cut before April?
Well, just because of the actual dynamic monetary policy that they've already implemented. They just raised, right? So they just raised, and they're going, unless something dire happens, then yes, obviously they could go in and make an extreme case to cut. But right now, what we're laying out is the timeline is, looks like an April potential will be the earliest for them. And that would put us ahead of Europe, and that just does not make sense to us.
In the meantime, as we're expecting those rate cuts to happen sometime next year, even if it's a little bit more delayed than originally markets had expected, does that mean that we will continue to disappoint to the downside and more pressure, given how much has already been priced in? And where do you hide out from the volatility?
Exactly. That's exactly the point. This is another time where the market's like, okay, we're going to get a cut, and they're pricing this in, and yet it probably will not come. The market volatility is really worldwide and global, and we're really expecting global macroeconomic changes. The joining of the BRICS bloc of Saudi Arabia and UAE at the beginning of 2024 in January is quite alarming and concerning to us. We're waiting to see what policy implementations will be made with OPEC, with that joining of the bloc. So these are the global macros that we're concerned about. We're obviously concerned about retail numbers globally, shipping numbers globally. We're seeing a slowdown in demand. And even the job market that showed a surprise beat of 199,000, if you look at the underlying headline, you see that 50,000 of those jobs were actually created by the federal government itself. So there's still real weakness in the retail sector. And if you look at the breadth of the market and the depth of the market, even though 2023 top line has been great, it has only really been with the Magnificent Seven, and doesn't have the breadth and the depth that we need to see to really think that we're going to get a true economic soft landing for the entire market.
What do you make of the Magnificent Seven? We have seen this immense rally, but at the same time, the S&P 500 seems to be so focused, at least the rally seems to be so focused in these few names. What's the risk going into 2024 at these valuations?
Well, I think if you look at NVIDIA, we have really a compound annual growth rate projection, especially in their AI chips, that they're really, they just have the market on these AI chips that are going to, and now they're having this situation with ARM. So what we're really seeing is the market expecting that these companies will continue to have this massive annualized growth. And I think in the AI space, potentially they will. But we also have to remember that the cost of capital for businesses now is like, 10x or more what it has been for the last 15 years. So a lot of these businesses for the first time are saying, we can't afford to invest in R&D and new projects and growth and expansion at the level we previously could with the cheapness of the cost. So a lot of the earnings and a lot of the growth next year is going to be impacted greatly by this higher cost of capital and these higher research and development costs that the companies haven't had to deal with for 15 years, because we've basically had the Fed funds rate next to zero for 15 years since 2008.
Rebecca,